Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures falling a bit after 3 straight days of gains as investors weigh more corporate earnings and trade war uncertainty. Stocks are trading near levels last seen around President Trump's tariff announcement in early April.
Plus, President Trump telling Time magazine in a newly published interview he expects to wrap up all trade deals in the next 3 to 4 weeks, and that 200 deals are already finished. The president also saying the U.S. is meeting with China and that President Xi did call Trump, but this comes after China denied negotiations have even started.
And could Alphabet's results be a signal of recovery for the rest of the Magnificent Seven? Alphabet reporting stronger than expected results, but the company is expecting some headwinds in its ad business as uncertainty looms amid the trade war. Plus, Intel CFO saying tariffs increase the odds of a recession.
Stock futures are sliding this morning after a 3-day win streak this week. Investors are digesting the latest corporate earnings and watching for the latest news on the trade war. We are seeing stocks near levels from earlier this month when President Trump made his tariff announcement here. Now, most notably, the difference between then and now is really the emergence of the companies that have started to speak up for themselves as well, not just commenting on what is most kind of privy to their own financial performance, but really what they're saying in the outlooks and the guidance, at the same time that some of these companies are actually having the ear of the president and trying to make the case for just how murky the outlook is. And I think that's continued to show up as a theme, is that uncertainty over the course of earnings calls, the releases, and the data that's come out. A lot of the companies that have pulled their guidance or said that they cannot reaffirm their guidance early in the early in the earnings season thus far, and then going into a big tech earnings week next week as well, where we'll hear from even more of those Mag 7 names.
And it comes amid a ticking clock for these companies as the trade war looms. The president saying that there is a negotiation happening, China quickly saying it is not. But Yahoo Finance was able to catch up with executives throughout the week about their reaction to the trade war amid their earnings results. Let's take a listen.
What you see is a reduction in the number of loads that are done per week.
We talk to consumers broadly about what is causing them to be on the sideline in this economy. It's really trying to save money, uncertainty around what's going on with the global economy.
What would happen is prices will rise for smartphones, and then people will slow down their purchases of smartphones, and upgrade rates will slow.
So the key takeaway, uncertainty, obviously the word of the year, but CEOs warning that that uncertainty could impact their margins as customers pull back on their spending. Obviously, that is impacting the stock market as we have seen continued losses, including over the past day, though this week has been a little bit of a relief rally, which is fascinating given the fact that nothing has changed. There's been a little bit of a rhetoric shift from the White House, but there has been no tangible news of negotiations happening. Right. So it'll be interesting to see if we're able to eke out gains on the week here.
Two of the conversations that we've had this week, one of them where I spoke with the AT&T CFO Pascal Desroches, who had talked about what consumers can expect, and that kind of mirrors what we just heard from T-Mobile in the end of that kind of clip mashup that we just played for our viewers, talking about where they're going to experience this. And it is on the handset side. If we see companies and Apple, Alphabet, Google, and some of the other smartphone manufacturers, if we see them unsuccessful in bringing over some of their devices ahead of tariffs actually impacting the prices that they're paying and then passing on to consumers, consumers are going to see that for some of the newer models if we don't have a deal in place. Now, we'll see what that looks like over the next 3 to 4 weeks, as President Trump is most recently talking about in his interview with Time. But that's one area where consumers could see this, is in the handsets. And then on the other side, you could potentially see this even more so in travel. I think back to our conversation just yesterday with Bob Jordan and how they're talking about needing to readjust their own outlooks as the rest of the airline industry has essentially had difficulty looking through the next 60 to 90 days and even beyond that to see what consumer demand might look like. And so it's a drying up in consumer demand, and it's also what companies might be doing on the employment front as well that could pressure the president as well as the Fed, and that's another major portion of this that the markets have had to digest.
It certainly is. It's one of the reasons Bank of America's Michael Hartnett this morning saying sell the rebound in both U.S. stocks and the U.S. dollar, saying the dollar is in the midst of a longer-term depreciation, while that shift away from U.S. assets has further to go. Really important context for our audience here, too, calling the current pain trade unquestionably a narrow, Magnificent Seven-led squeeze higher in U.S. stocks and the dollar, noting that there is potentially some concern about people buying the dip in Mag 7 names that were already overvalued. What does that mean for those valuations going forward if you do not follow Hartnett's advice here, which is, again, to sell that rebound? We're going to continue the conversation about what this earnings cycle might mean for those Mag 7 names. Alphabet topping the street's expectations in its first quarter with over $90 billion in revenue. Google CEO Sundar Pichai crediting the company's approach to AI for the strong results. Here to discuss what Alphabet's results mean for tech investors more broadly, we have Nancy Tengler, Laffer Tengler Investment CEO and CIO. Nancy, great to have you this morning. Are Alphabet's results a signal of a broader reprieve for the Mag 7?
It could be, Madison, but it's also coupled, and thank you so much for having me. It's also coupled with ServiceNow, who delivered probably the best quarter they've ever delivered. Texas Instruments, who beat and then raised guidance. So there's something going on under the surface, and we have believed that the AI trade is early innings, that companies would continue to spend. We're seeing use cases explode, as I've talked with you about before, across sectors. One of my clients just got back from Las Vegas, and they said they barely have dealers anymore. Blackjack is done by machines. I mean, that's an interesting form of utilizing new technology. So I think, or utilizing technology, not necessarily new, but I think we're going to continue to see that. It may put some pressure on the jobs market, but I do think it bodes well for the companies reporting next week.
Nancy, as we're thinking about some of those companies reporting next week and really trying to assess what the investor checklist is for this environment where companies are having to acknowledge the present risk of tariffs. Of course, uncertainty is always there, but this seems more pressing for them to need to address when they are speaking directly with analysts and investors. What is that checklist that investors should be working through as they're assessing what that exposure looks like in their portfolio?
I think, Brad, there's one issue that every investor should be paying attention to, and that is guidance. Now, managements have no incentive to provide guidance because they have the perfect excuse in the tariffs. But we are hearing management teams saying things like, we're upholding or we're raising our guidance in the current tariff environment. The problem is nobody knows what that actually means from day to day. But I think you want to look at margins. Are they contracting? Free cash flow, is it continuing to expand? And then, of course, revenue growth is also important just because that's sort of a bellwether on the company's future. Because as we know, earnings can be, I don't want to use the word manipulated, but they can kind of be manipulated. So you really want to pay attention to the top line.
Yeah, the numbers don't lie until they do, Nancy. I am curious, from your perspective, you can talk to me a little bit about some of your 5 best stocks to buy in 2025. One of them on this list is Amazon, which of course is not completely immune to any impact of tariffs. Talk to me about your view on Amazon and your level of concern about tariffs and just broader economic uncertainty with a name like that.
Yeah, well, so I picked those names in December, but we're still buying Amazon because I think it's important to acknowledge their pricing power and their ability to influence their suppliers. So we've heard that the management's very confident about the retail side of the business. We know the cloud business is growing. Yes, they're going to be spending a lot on CapEx, but after CapEx, they're still generating about $100 billion in free cash flow. So I think it's important that they deliver some indication on what they're seeing in the marketplace. But we heard the bank, there's so many cross currents, Madison. We heard the bank CEOs come out and say that consumers not only were spending in the first quarter, they increased their spending, according to American Express, after tariffs were announced. So is that pull forward? Could be. But how much of that is it? And that's what we want to hear from Andy Jassy.
And so with that in mind, some of the other names that are on your list here, Spotify is one of them. And, I wonder your thesis around Spotify, especially as we've kind of heard some of the analyst commentary, look at names, platform plays like a Spotify, like a Netflix even, and try to assess how that would hold up on the subscriber basis and then grow out its business even more if we did see any hesitancy in consumers to pay further into those experiences?
Yeah, so when we put it in the list, and all of these stocks are in our 12 best ideas portfolio. So we also own Netflix, but it is not in that portfolio. We were assuming and believed and still believe that the economy is decelerating. We're not in the recession camp. I talked with Madison about that the last time I was in New York, which is about a month ago. But we do think things are slowing or will slow, even though the earnings are belying that. But again, I think some of that's pull forward. So where you want to go in that environment, many are arguing that you want to be in healthcare. We're there. You saw Abbvie's earnings this morning. Very good. It's our largest healthcare holding. But you also want to be in subscription-driven names and entertainment in particular, where that's going to be the last place to go when consumers are cutting their budgets. And they're still working. Real wages are still improving. So I think these names, both of them, but in particular Spotify, which has been a monster performer for us, continue to have a decently long runway as we move forward into a decelerating economy. And then it's kind of an all-weather stock. Even when things are improving, people continue to utilize the service. And lastly, they've been very smart about opening up their platform, which is and allowing Joe Rogan to be viewed or listened to in other on other platforms. That has improved advertising, and that's what's going to continue to drive earnings.
Nancy, we can't let you go without asking about one name that you're adding to amid a lot of chaos, a slew of potential headwinds, and that is Tesla. Talk to me about how you're viewing this name, where you see it heading, and why.
Yeah, dreadful earnings, but Elon came on and said, "I'm back," and the street like that. So what we've always said is, yes, you have to sell EVs, but it's an AI play and it's an energy play. So our favorite part of the business is the Megapack. Electric utility grade business. And then if you look at full self-driving, it's on its way. I don't know if you've ever driven one, Madison, but I was a skeptic and now a believer. These are amazing vehicles. And as soon as I get a garage, which is on hold because of tariffs, I'm gonna get a Tesla and plug it in because they're amazing vehicles. But sorry.
No, please finish, Nancy.
No, I was just going to say, but they need vehicles to sell in order to continue to generate the data and all of the the AI necessary for full self-driving.
Sounds like you may have hit that ludicrous mode button in their Tesla experience, Nancy. Thanks so much for taking the time here with us this morning.
Thank you.
Apple reportedly planning to shift more iPhone production to India amid trade policy uncertainty and 145% tariffs levied against China. It's the latest move in Apple's shift away from China. Yahoo Finance tech editor Dan Halley joins us now to break it down. Take us further into this decision and this move from Apple.
Yeah, Brad, it looks like Apple, this is according to a Reuters report, is trying to get the majority of its iPhones for the U.S. market from India rather than China. Basically, they've had plants there. This has been something that Apple's been working on for quite some time. There was originally plants built there so that they could sell phones in India. They needed to have a manufacturing footprint there, and they've continued to build that manufacturing footprint out as a way to diversify its supply chain away from China. That was something that really took off during the supply chain crunch around COVID, and they've continued to do that since then. But now, obviously, with the tariffs discussion coming back, they're just adding fuel to that fire of getting out of China for U.S. products. That's not to say that they're, closing up shop as far as manufacturing goes in China altogether. That's not the case at all. They're moving the U.S.-bound iPhones to India, and so they did this previously ahead of tariff announcements. They had plane loads going to the U.S. from India to try to get around tariffs on Chinese goods. And look, this is what companies are going to have to navigate now. Yes, there's an exemption on smartphones right now, laptops as well, computers broadly. But the Trump administration had said once those tariffs on semiconductors come into play, well, the exemptions for those other devices, those laptops, desktop smartphones, could go away. And so these companies are now thinking, okay, well, one day we have an exception, the next day we don't. What's going to happen? Are these tariffs going to come down? There's all this talk, but no real movement. And so this is Apple obviously hedging. Their supply chain masters. They're among the best at this. And so it seems the overdependence on China had them flat-footed for a moment, but they're really pushing full throttle into India.
Yeah, and important to note, of course, there are going to be tariffs on India as well, those negotiations ongoing, but certainly less than the over 100% from China. At least that could be good news for investors. Dan, thank you so much. Appreciate it. Coming up here on the Morning Brief, we're going to count you down to the opening bell on Wall Street. Stocks still below the flat line here. Plus, we've got more reaction on Alphabet and Intel's quarterly results. We'll also dive into some other corporate reports from Abbvie, SLB, and Colgate. That and much more on Morning Brief ahead.
Now time for some of today's trending tickers. We are watching Abbvie, SLB, and Colgate. First up, Abbvie lifting its 2025 profit forecast after reporting better than expected results for its newer immunology drugs. The company says its updated forecast does not reflect possible U.S. tariffs on the pharmaceutical sector. We're keeping close tabs on shares, up by about 4.5%. We have a comment from the company's chief executive officer, Rob Michael, over there, saying that the first quarter results, well ahead of their expectations, reflect an excellent start to the year. And then the fundamentals of their business. They believe they are strong right now and continue to bolster their outlook with some pipeline advancements and strategic investments right now.
Yeah, I think it's really interesting to talk about a name like this. We just had Nancy Tengler on. She said this is their largest healthcare holding, talking about how the company's results, they don't reflect any trade policy shifts that could come from the pharmaceutical sector, but that guidance, at least for now, looking like it beat expectations, and that's why you're seeing those shares up. Really interesting potential recession indicator in the results, seeing weakness in some of their more vanity-style offerings, the likes of Botox injections, for example. Is that potentially an indicator of slowdown in consumer spending? They're seeing more of the strength in autoimmune meds more broadly. That helped them surpass quarterly results as well.
I paused my injections last week. So.
Hey. I've yet to start because I'm concerned about, an economic slowdown. So we will discuss our Botox treatments in the break. But next up, Schlumberger missing first quarter profit estimates. That's SLB, weighed down by weaker demand in Latin America. The oil field services provider offering a cautious outlook due to economic uncertainty, tariff risk, and volatile oil prices here. Also really interesting, joining the likes of their competitors, one of them Baker Hughes, in flagging more caution ahead, missing those estimates for first quarter profit. Also saying that there was weaker demand specifically in Latin America that dragged on its international business, and warning again of that industry-wide shift amid economic uncertainty and, of course, volatile oil prices, which are a key focus of the current administration. So it's likely to continue.
I appreciate them for just letting us say SLB going forward from here. But a few of the things that I noted within this report specifically, some of the sequential changes year over year. Revenue was actually down by 9% in this most recent quarter. You also saw some of the core adjusted EBITDA also off by about 15%. So some major reasons why investors are actually sending shares lower by about 2.9% right now off of the back of this earnings result. Also, finally, Colgate reporting a higher first quarter profit, but lowering its 2025 earnings guidance. The consumer products maker expecting to take a hit from tariffs here. We're taking a look at shares up right now by about 1.4%. And it's been an interesting week to hear from companies like Colgate, companies like Kimberly-Clark, as well as Procter & Gamble, just about what they're sensing in the consumer environment right now. And for many of them, trying to best assess how any pullback in some of the either number of loads of laundry that you're doing, as Procter & Gamble was talking about, or P&G, versus Colgate. And I hope people don't, stop brushing their teeth and doing all of that. But again, this is at least an interesting environment for them to navigate the frequency at which and the replenishment rate for consumers of their products.
Yeah, I mean, it's interesting, right? Why is the stock up? Yes, they posted that higher profit, but still looking like their sales growth is set to be lower than previously stated. Having said that, they do anticipate sales being up in the low single digits with a smaller impact due to foreign exchange rates. This is one of those names that really does stand to benefit from a weaker dollar. Obviously, that has been a key storyline over the course of the last couple of weeks here as that dollar weakness comes in. But more more broadly, the story with a name like this, with a name like P&G, like you mentioned, Brad, these are consumer staples. So if these names start to see weakness, we heard earlier this week from P&G, people doing less laundry because of the economy, that is a really important indicator for folks to be keeping an eye on. And also, I should mention, you can scan the QR code to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Alphabet earnings came in ahead of analyst expectations, with the tech giant reporting higher than expected sales in the first quarter. Google's ad sales revenue growing 8.5% in the quarter, its slowest pace of growth since 2023, but still growing despite competition from AI search options. Google's parent company also reaffirming its $75 billion AI capex for the year. Here to break down what this latest quarter means for the tech giant, Ronald Josie. He is Citi's senior analyst. Ronald, it's great to have you here. So, talk me through the AI rundown and the impact that had, because there was this concern that, to walk our audience through it, if you Google something right now, you're most likely going to see a little AI rundown at the top before you get to all the stuff that has more ads on it. We were worried that was going to be a ding to them, but it didn't happen. Talk me through it.
So I would say this is the first quarter that we've heard them talk about the benefits from AI overall. We've been in a wait and see mode for some time, just given their overall, investment in Gemini, in search, in AI, and the list goes on and on. And so this quarter, we actually heard that AI overviews, which specifically is on the top of your search results, is helping to drive incremental clicks. And not only is it helping to drive incremental clicks, it's helping to drive clicks more often. And these are more commercial types queries. And so frankly, what we heard this quarter was actual search revenue grew 10%, thereabouts. That's a positive. It's better than we were expected. AI overviews now rolled out to ostensibly the vast majority of Google search users, is delivering greater overall searches and engagement. And we also heard their newest version of search, which is called AI mode, which is actually to the left of that all section, is actually seeing promising results as well. And so what I'm trying to get at here, for the first time, I think we're seeing and hearing their investments in Gemini and AI actually drive results. And that's a very good first step. We're not out of the woods, still a lot of question marks. They're playing from behind to a certain extent, but that certainly was a major takeaway from last night.
And are the monetization efforts of those investments in AI, is that holding up against perhaps the early innings measuring stick that we're trying to assess what the total return going forward will look like?
Yeah, so relative to total return, still TBD, because there is a good amount of investments going on in the cloud, and specifically they were talking about demand in cloud remains is basically outstripping their capacity, which I think is something that is a good thing to a certain extent, and they can build into it. I've been covering Google for a long time now, and we've never heard them talk about capacity challenges, but that seems to be industry wide. So to talk about overall AI ROI, if you will, still early, but at the very least within the search business, we can now hang our hat, or at least point to places that are driving better results. There's a lot of debate on whether AI overviews or the AI within search is impacting click-through rates, and therefore, overall tonnage of advertising clicks. And so that's TBD, but last night results suggest that it's not having an impact. And so, we'll have to monitor that going forward, but early days here, good.
Yeah, and so Ron, a lot of investors, they're old enough to remember that massive leg lower that we saw earlier this year for a lot of the AI-focused or heavy CapEx AI names was driven by DeepSeek, was driven by an international competitor that really just had kind of its early results that were tossed out there. Does what we heard from Alphabet last night mitigate the concerns that some of the investors might still have in the back of their minds about international competition, namely DeepSeek at this juncture?
Yeah, I think it's, so I wish I had a real answer for you other than to say it's still early. I think there's a lot of debate on what the right, not level of investment, but just the results of what AI really can be going forward. But my view here is when you're investing as much as Google and Meta and Amazon are in their AI infrastructure and capabilities, as new models launch, Gemini is now at the top in terms of, I believe, in AI arena. And so, as long as they continue to deliver better overall results and more companies are building on top of them, meaning Gemini and Meta's Llama and maybe some of Amazon's models as well, like Novo, I think that helps to assuage some of the fears. And so when you think of,
Sorry, I just want to we've got about 30 seconds left, and something that really stands out to me is that Alphabet has the lowest valuation multiple of all those names that you're talking about. To what extent is that a signal for investors to get into this name despite any of the macro headwinds we may be facing here?
Yeah, so I mean, look, macro is still a big question mark. It was nice to hear. I mean, 1Q results were good. 2Q insights seem seem okay. The real question is going to be the back half of the year. There's no doubt about that. You talked about valuation. Look, there are real overhangs and debates on Google stock right now. One being, of course, AI and that sort of existential risk. Two being revenue growth. Three, profitability. Four, regulation. The list goes on. At the very least, I think you come out of 1Q earnings feeling better about monetization. And I think valuation means the risk reward is actually quite favorable.
Ronald, thanks so much for joining us just after these results. We appreciate it.
Thank you.
When we return, opening bell on Wall Street. Stay tuned. You're watching Morning Brief. It's the opening bell on Wall Street. You got the Arbor Day Foundation ringing the opening bell at the NYSE. Let's see if they can find some more buttonwood trees to plot in the ground somewhere. And the NASDAQ, you're seeing a live look at the opening bell there. I can't see what they got in their hands. It looks like some snowflakes, maybe chips, poker chips. All right, we'll just call them church fans for right now. Merex ringing the opening bell at the NASDAQ. Taking a look at the major averages as we begin today's trading activity. Flat just barely to the upside for the S&P 500. We'll see if that can eke out some gains and cement this streak that we've seen over the course of this week after Monday's deep move lower and then the rebound over the past the past few sessions here over the course of this week. We're taking a look at the S&P 500. Let me just give you a view, line chart, if you will, of how we've been seeing the markets play out over the past 4 sessions right now, up net by about 6.4%. I'll put this on a 5-day view here, net higher by about 3.9% for the S&P 500. That takes into account Monday's activity as well. And then additionally, taking a look at the Dow Jones Industrial Average over that past and same 5-day period, net higher by about 2.3% here. The NASDAQ composite as well. Out of the gate, yeah, we're flat, but to the upside right now. But higher by about 0.1%. Let's take a look at the year-to-date view. We'll just put all of this in context for you as we were tracking that. There we go. YTD, you know me. Taking a look at the NASDAQ composite year-to-date, still down by about 11%. Out of the gate here this morning, we are seeing some gains, so we're a little mixed right now. Take a look at the NASDAQ 100. We were just breaking down some of the earnings results. We've been tracking Alphabet, Google, whatever you're calling them. Call them higher here. Out of the gate, up by about 3.4% after earnings yesterday evening. And then also taking a look at some of the other mega cap tech stocks, a little bit mixed here right now, fractional decline for NVIDIA and Amazon. Meta platforms perhaps catching a little bit of attention in the same kind of digital advertising mindset or thesis as Alphabet here this morning. Meta platforms is up by about 2.25%. Microsoft seeing some fractional gains as well. And then just lastly, let's take a look at the 11 S&P 500 sectors. We are being led right now by communication services. That shouldn't come as a surprise. That's up by about 0.7%. However, bringing up the caboose, you got some jostling for that last place position, but energy, as of right now, XLE, that has it. XLB was putting forward some effort there. Materials also pulling up the caboose here on the day. With that, I'll toss it back on over to you, Maddie.
Thank you so much, Brad. It's time now for today's strategy session. Stocks a little changed after 3 days of gains as investors digest more corporate earnings and the latest commentary around the trade war. Joining us now with more, Michelle Schneider. She's the chief strategist over at MarketGauge.com. Michelle, it's great to have you. And you sent over some really helpful charts comparing this moment in time to what we've seen in other moments of intense market volatility, including 2022. What are you seeing now that you've seen in the past that indicates to you that there may be more pain coming for this market?
Well, we don't really know about the pain part yet, and that was the whole point of the comparison. And by the way, good morning to you guys. In 2022, after we had a tremendous aggressive amount of rate hikes from the Federal Reserve and a big down move, in October, if you're watching the gold to silver ratio, which I watch all the time because, it's certainly been bullish gold for years and now maybe it's peaked out a little bit. I was waiting to see what would happen with silver. So in 2022, it was really interesting because right in October, that gold to silver ratio peaked at around 95, 96. At the same time of that peak, the next day, what started to happen was that silver started to rally which would then begin to outperform gold in terms of relative ratio. Number one. Number two is it looked like the TLTs bottomed at that particular time. The dollar certainly had started its decline after having a peak high at around 114. But the SPY, even though it was trying to bottom, it actually chopped for months and months until the Fed policy really changed from aggressive rate hikes to pause. So now if we fast forward to 2025, we're watching the same kind of thing potentially unfold, right? So for the first part of it, gold to silver ratio went up to like 105, 106, which was tremendously high. That was the whole race into gold as a safety play. Now silver is trying to actually rebound here. We're not sure yet, and that's going to be a key recessionary indicator, but that's number one. Number two is the TLTs are also trying to bottom. Before Fed policy starts to change from stay the course to possibly lower, we don't know that yet, but that would be important to keep an eye on. The dollar, of course, has already been in decline. However, it can have these little pops here and there. And finally, the SPY, if it has bottomed, it could chop around for a while, which would kind of match what we saw in 2022, is that it would take some time, but then by the second half of the year, we could start to see it catch up.
And so people, I think, want to know, with the additive of tariffs within the mix right now, that has certainly been the kind of self-induced portion that has been tough to really know exactly what the course of direction is there. The relief would be around, okay, if we do see any type of negotiations come forward, then that would mean perhaps rally back on, we can get back to some of the normalcy. How does that additive make the analog that you were just breaking down of the historical element to all of this? How does that additive either change things dramatically or keep things the same to a certain extent?
Well, that is the question, right, Brad? I mean, that's what everybody's wondering. For example, I've been seeing a lot of buzz about this Zweig breadth thrust, which triggered this week, which has been 100% accurate in calling a bottom in the market. But of course, we're in a completely different world right now with higher valuations and tariffs on the table. So one would have to assume that if you step back from all of that, what these indicators of the gold to silver ratio, if silver can hold up, like I said, if bonds can bottom and the SPY can hang in here, probably is projecting that at some point the tariff negotiation will result in something that at the very least gives people more confidence that the worst is behind us. We don't know that yet. So that's why I wouldn't run in gangbusters, but at this point, I would certainly watch to see how all these areas unfold.
One of the correlations that my sources have been flagging this week, of course, is stocks and bonds. And if yields don't decline when stocks sell off, investors, maybe they'll discover that they've been kind of paying for a hedge that isn't working anymore. That is from a note that I was reading this morning. To what degree do you look at that relationship, and what is it signaling to you at the moment?
Well, it is a very key relationship because it really gives us an assessment of risk on or off. And generally, you want the SPY to be outperforming the long bonds if you're going to look at SPY versus TLT. Yet, at this point, the TLT, they're in a battle, the TLT and the SPY in terms of its ratio of performance. So essentially, what you really want to see is, even if the rates come down, you want to see the SPY start to outperform stronger. If the TLTs start to outperform because the rates are cut and it doesn't help the SPY, that's really going to be not only a risk-off situation, but potentially another nail in the coffin towards recession. But again, these are all unknowns. These are just things, good signs to watch, so you're not as headline focused and more on these relationships that are so important.
One relationship that is perhaps the Roman Empire for much of the markets is the relationship with Fed Chair Jerome Powell, and trying to understand how a data-dependent Fed is going to start to read through prints that could start to show hesitancy or increased hesitancy on the consumer side, and then how businesses are also positioning what their headcounts look like if there's a material change in employment. How are you looking through some of the hard data that's going to start to come out as well next week to really assess how the Fed may start to change its tenor?
Well, they're going to look at labor. So right now, jobless claims that we've been seeing in the last few weeks are really not flashing any kind of warning. We have unemployment, of course, in the first week of May. That'll be key. We've seen the inflation numbers come down to a degree, but not under the 2% that the Fed wants. And of course, the tariffs and supply chain and what's possibly happening in terms of goods coming into this country being blocked. That could be inflationary, which is exactly what Powell has been saying. So it's hard to say. I think if they see things really breaking, I mean, we're already seeing housing sales going down, businesses having a lot of issues, bankruptcies starting to pick up. That could supersede their typical dot plot. But again, that's why I like these relationships, because the TLTs haven't actually shown us yet that the Fed is willing, other than the natural attrition of the rates going down while people are starting to buy bonds in anticipation, that they're ready to do that. And yeah, they're going to be really careful about inflation. And let's face it, right now we're in stagflation. That is a very hard economic situation for the Fed to set monetary policy on.
Michelle, great to see you this morning. Thanks so much for taking the time.
Thank you so much for having me.
Coming up, Intel announcing plans to cut expenses and boost innovation. We're breaking down the battle of the chip makers and how Intel is looking to become more competitive. That's next on Morning Brief.
Intel's first quarter earnings topping expectations, but the positive results were overshadowed by a disappointing forecast for the current quarter. The company citing uncertainty caused by none other than tariffs. The chipmaker also announcing a major workplace overhaul to help boost innovation as it looks to become more competitive. Joining us now, Matt Bryson, Wedbush Securities MD of Equity Research for Hardware. Thank you for being here with us, Matt. Obviously, the reaction right now negative because the stock is down over 8%. Talk to me about what investors are most concerned about.
Well, I mean, it's another disappointing guide for Intel, right? So I think there was some hope that we'd get something better, and we didn't.
Okay, so with that in mind, as you're thinking about how Intel is trying to position itself and kind of unloading some of the weights to its business, is it effective at this juncture? Should investors read through as that being a positive signal, or is there still more work to be done?
I think the question with Intel is kind of the same question that we had when Pat Gelsinger was still CEO, right? So Pat's plan was we're going to turn around Intel manufacturing, and that's where Intel went wrong. They fell behind Taiwan Semi in manufacturing, so they were underutilized. The products weren't as good. That potentially happens end of this year with 18A. That timeline hasn't changed. And I think that we're going to find out Q3, Q4, whether or not Intel's got the recipe right and whether or not they're executing. But till then, it doesn't matter whether it's Pat who's CEO, whether it's Lip-Bu who's CEO. They just are struggling with the set of products that they have right now. Is Lip-Bu's strategy the right one in terms of right sizing? It may very well be. But I just don't think there's much he can do until he gets these new products out, and they either work or they don't.
And I know you've spoken about how the near-term results are perhaps less important because the company's trading at around equity value, perhaps a little bit lower than that after today's move. So what do you think is the next big potential catalyst that could lead to any type of relief rally for this name?
Well, I mean, I think like with the rest of the market, certainly if we can get the administration to figure out what they're doing in terms of tariffs and hopefully choosing to not be as protectionist as they've chosen, I think that certainly would be a catalyst for Intel. Of course, it would be a catalyst for almost everything. But Intel's a bit more caught maybe than some of its peers. So certainly there's been speculation out there that China is going to tariff semiconductors by point of wafer origin, which for Intel is the US. So that's a problem. If you can resolve those issues, that would be maybe a little bit better for Intel and a positive catalyst. But beyond that, from a company specific standpoint, I think it's getting good news around that 18A process, getting good news around that Panther Lake product set, which is built on 18A. That's the next company specific catalyst, I think.
And so further to that end, it's also the vertical integration of how they're designing, but also having their own foundry and managing that in-house versus some of the other semiconductors that are simply designing and then outsourcing fabrication processes. So how quickly do they need to bring not just bring more fabrication online, but then additionally rely on being able to take market share? It's not like they're going to take, 50% even of the market share from NVIDIA, I don't think. But what is a good kind of modeling basis that you're using for how much of that market share that they realistically could take and benefit from?
Yeah, so I think that's going to be a lot longer term. So when you talk about them getting into the AI space, they've had a deficient product set. I think that you look at with Bhutan, who's got great relationships throughout the space, who's able to talk with customers around what they need. I think that gets them there eventually, particularly if 18A works, right? They can take that manufacturing capability and they can use it to build products for Amazon, for Google, potentially at some point. But that's not something that's going to happen in the next 6 months, 12 months. That's longer term in nature. I think more what would benefit them again is if Panther Lake works, it means that they can make more of their chips internally. That increases their utilization. That benefits gross margin. The cost of those wafers goes down, so that also benefits gross margin. When you have better costs, there's a bunch of things you can do, right? You can price more aggressively to take share. And so all of that is good. And it all comes down to, is their 18A process a good one, which I've started to hear better things about it, but you just don't know until you know.
Matt, does it seem like much of the thesis for investing in Intel versus some of the other semiconductors that maybe just the worst is behind it right now? How are you kind of evaluating the share price action that you're monitoring on a daily basis?
Yeah, so I mean, again, it's hard to say. So if I'm a bull, I'm thinking they've got 18A right. It's trading around book. And so things get better from here because they're going to be able to shift more manufacturing back. That's going to lead to better gross margins, more competitive products, share regain versus AMD. If I'm an Intel bear, I don't believe in 18A. I look at, why would you fire Pat Gelsinger when you've got these better products that are, less than a year away? And I think that book doesn't matter, because if my assets continue to lose value because I can't use them to make good products, and I'm going to run into a financial problem, then who cares what book is? And right now, obviously, I've got a neutral rating, so I'm still trying to figure out, is this a good process? If it is, then I think a lot of Intel's problems take care of themselves. If 18A isn't good, if they're going to struggle in manufacturing, the problem is there isn't a good way to separate the business, right? There's been rumors around TSM may work with them. I just think that's going to be hard to do.
Right. Okay. All right. Taking us into your kind of decision tree as to whether or not we could see some type of price target or rating change in the future, but it depends upon what comes forward from Intel. Matt, good to see you. Thanks so much.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. Now time for some of today's trending tickers. We're watching Pony AI, Alphabet's Waymo, and Meta. First up, Chinese startup Pony AI is teaming up with Tencent to develop self-driving technology. The companies will integrate Pony AI's ride-hailing services into Tencent's extremely popular WeChat app and Tencent Maps here. We're taking a look at Pony AI. It's up by about 10-11% on this news with the strategic partnership, they're calling it, to advance autonomous driving technology and robotaxi commercial deployment here.
Yeah, a huge move to the upside. That stock up right now nearly 11%. But in other robotaxi news, Alphabet's Waymo did report over 250,000 paid robotaxi rides per week in the United States. That's up from 200,000 in February, which was just before the company expanded in San Francisco and opened up in Austin, Texas. Alphabet CEO Sundar Pichai says Waymo is building partnerships with Uber and other automakers to help expand its footprint even further. You can see those shares up over 2%, of course, off the back of those results. But interesting to see that amount of growth in Waymo, considering that it seems like the growth pace is quickening at this point, given the fact that they were able to add on those additional 50,000 riders just over the course of about a month here.
Yeah, said they're now safely serving, and on the earnings call, talking about safely serving over 250,000 paid passenger trips each week. That is actually up 5x from a year ago.
Yeah.
Also here, finally, Meta is laying off more than 100 workers in its Reality Labs unit. That was first reported by The Verge. These cuts will impact the team that creates content for the company's Oculus VR headsets. And we're taking a look at shares of Meta here. They're still fractionally higher on the day, especially as we're kind of waiting for even more of those tech results to come forward next week. It'll be interesting to see if we see some more headcount moderation, unfortunately, especially going into some of the employment data that's also coming forward on the econ side next week.
I think it's interesting that we're not seeing Alphabet results leading to a broader lift in some of the big tech names. Obviously, the macro environment and uncertainty weighing on stocks more broadly today. But I thought that if Alphabet was going to be a lift to any other name, we were talking earlier that Meta might be one of those beneficiaries because the ad revenue stories are relatively similar between the two.
Yeah, I was taking a look at it at the open, and Meta was up. I think it was up by about 2% at the open. So it's moved off of some of the early session highs, but still holding on to some fractional gains right now. And you're absolutely right. As we were talking about it earlier, it really comes back to how digital advertisers are thinking about where they want to place some of those marketing dollars. And this essentially has been, for a long time, the duopoly is being shaken a little bit. But for Meta and Alphabet or Google, they really have been that digital advertising duopoly for many, many years.
Yeah.
But it's getting shaken up a little bit.
It's getting shaken up. I mean, the uncertainty is, of course, the word of the day. And you can scan the QR code to track the best and worst performing stocks with Yahoo Finance's trending tickers page. That's going to do it for the morning brief. But I want to go out by giving us a look at the broader market here. You're still looking at losses across the major averages, though no intense selling as of yet in the market action. You got your S&P off about 0.2, your tech-heavy NASDAQ off about 0.1. Join me in the next hour for more analysis on Catalyst. Stick around.